Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nick Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad. Another good day in the markets today. I think we're about to set a record, for 9 or 10, 11 straight days up in the S&P. So, I think everybody watching this show is probably pretty happy.
Absolutely. Well, this week we were going to talk about value traps, but Nick, you and I spoke just a couple days ago, and recognizing that Berkshire Hathaway's annual meeting was this weekend, we decided
big news.
Yeah, absolutely. So we decided to pivot, and this is frankly going to provide a lot of content for us throughout the week. I'll be writing about a lot of the comments, a lot of the nuggets of wisdom that were accumulated, and of course.
If you guys like Warren Buffett, tune into the Wide Moat Daily, because I think this might end up just being like a Wide Moat Research celebrating the Oracle of Omaha all week.
Yeah, well, one thing noticeable, of course, is I miss Charlie Munger. It's really not the same with Charlie Munger there, and of course, some really interesting news, and the market's kind of reflecting it here so far this week, is the successor. So I decided to write today on succession, which I think is an extremely part of the investing world. And of course, what I mean is Mr. Buffett announced that Greg Abel would be taking over the reins of Berkshire Hathaway. What do you think about that?
Probably a good move. I whatever Warren Buffett decides to do, I trust it. I've just followed his kind of advice my entire investing career, and I'm sure Greg Abel's a very capable leader. I saw the stocks down, 6% today. So it looks like a whole lot of people literally just owned those Berkshire shares because they wanted exposure to the mind of Warren Buffett. But long term, I'm sure the company will be good. And you know what? I don't know if he'll do it, but if Greg Abel initiates a dividend on those Berkshire shares, I will be happy, very happy to accumulate a large stake.
Yeah, no, I agree. And of course, at 94 years old, Mr. Buffett's still in pretty good shape. So, although I think succession is obviously critical, probably should have done it long before this. Definitely his mind was all there. There's a lot of content, as I said, that I listened to the transcript, to the recording this morning of the show. So there's a lot of interesting things that he talked about throughout the weekend. And one of the most interesting things was just the amount of cash that Berkshire Hathaway now has sitting on the sidelines. And Nick, what are your thoughts on that and kind of that cash is king mantra?
Yeah, it's interesting. Almost $350 billion. I think Berkshire owns 5% of the entire U.S. Treasury market, something like that. It's incredible. And it looks like he's setting up, Mr. Abel to do something. He said he had a funny quote in his meetings this weekend. He said, he's not humble enough to not spend it. If he sees something he wants to buy, he will. But a lot of people think what he's doing is setting up the next CEO to have a pristine balance sheet and a lot of opportunity to make deals. So if you're a Berkshire shareholder, you got to be pretty happy about this.
Yeah. Well, another interesting thing that he talked about, and actually these came from a lot of questions over the weekend. I actually decided to write on this today. One of the writers or one of the people at the conference talked about real estate and really asked Mr. Buffett whether or not he would, why he didn't invest more in real estate given this time. Now, as I wrote about 2016, I published this book called The Intelligent REIT Investor right here, and I'd sent a copy of that book to Mr. Buffett, and which I thought he would be interested in REITs. Obviously, he knows what REITs are. Many probably don't recognize that he actually bought personally one of the outlet REITs many years ago called Tanger Factory Outlets. We still cover that company here at Wide Moat Research. And right after I sent that book, literally several months later, Berkshire Hathaway actually bought a REIT, Store Capital, which I thought was really interesting. However, Mr. Buffett has definitely been less interested in playing the private real estate market.
Well, I mean, he owns so much infrastructure. I don't know that he needs to. They own a railroad, ton of land. They own utilities. They own pipelines. He's very heavy into energy these days. So I think as far as like the hard assets and kind of infrastructure plays, it seems to me that he prefers kind of the energy side of things. So I'm not surprised to see him light on real estate, especially since he has so much exposure to the banks. I mean, I imagine there's a lot of kind of mortgage and commercial mortgage exposure kind of indirectly through his bank holdings.
Yeah. And one of the points he made, of course, and this is being a developer by background, he talked about the amount of time it takes in real estate from the beginning of negotiating a deal to actually closing a deal. It could take years to get a deal closed. Whereas, of course, you invest in the stock market, and one of the great things about investing in the stock market is the liquidity. You get to buy and sell at any time. Warren Buffett, this is what he said. I think if you'd asked me to make a choice when I was 21, either be in stocks exclusively for the rest of my life or real estate for the rest of my life, he would have chosen stocks. There's just so much opportunity, at least in the US, that presents itself in the security market than in real estate. So that makes a lot of sense. Now, I will say, and you'll have to read my article, I do think there's a case to be made for investing in real estate stocks, because you can push that button fairly immediately or sell shares just like you would any stock, which is what a REIT does. Nick, any other? What are your other takeaways from the call over the weekend?
Yeah, no, I mean, they're just doing what they've been doing. I've been waiting to see them make a big acquisition. I think they sold that massive Apple stake that they bought. He timed that up perfectly. He bought Apple at about 12 times earnings, kind of X cash. He sold it at the top. I think he said Tim Cook's made more money for Berkshire Hathaway than Warren Buffett ever has. So that's a pretty funny and kind of humble quote that came out of this weekend. I'm looking at some quotes here. I'm just interested. What I find most interesting about Berkshire shares right now is they held all this cash. They're super defensive, and yet they're still one of the best companies in the S&P 500 right now as far as year-to-date returns. So you kind of get to have your cake and eat it too with this one. You get massive exposure to upside if the market sells off, because they're going to be out there buying beaten down companies, but they're not trading like a boring defensive stock. They've been doing great all year. So I think this is just kind of a company that hasn't gone wrong in a while, and it'll be interesting to see what the new CEO does, but I'm sure it'll be more of the same.
Well, look, I think I found a couple really good quotes, and I thought I would mention this one, talking about patience and the amount of cash that we just talked about on the balance sheet. And this is a quote he had over the weekend. You will see a period in the next 20 years that will be a hair curler compared to anything you've seen before. That just happens periodically. The world makes big mistakes, and surprises happen in dramatic ways. The more sophisticated the system gets, the more surprises can come out of left field. Now, this is the important. That's part of the stock market. And that's what makes it a good place to focus your efforts if you've got the proper temperament for it, and a terrible place to get involved if you get frightened by markets that decline and get excited when stock markets go up. I don't mean to sound particularly critical. I know people have emotions, but you've got to check them at the door when you invest.
Yeah, no, the Warren Buffett has essentially just created all the wide moat mantras that we use. And I love, he talks about with regard to those holdings, he says his favorite holding period of time for a stock is forever. Obviously, that's more of a kind of do as I say, not as I do type thing, because if they do have a lot of turnover in their portfolio. He is not a strict buy and hold investor. Some companies like Coca-Cola, he's owned for decades, and he said he's never going to sell that. And maybe he will, maybe he won't. I don't know. Like I said, he trades out of airlines. He's sold Apple. He moves in and out of the banks kind of. So that's not a perfect thing. But I think the most important kind of change that we've seen in Berkshire over the last 10 years that I think every investor kind of should follow is their focus on quality more so than value. He began as a value investor. I mean, I know you've talked about cigar butts. That's what he did. He bought a beaten down, textile company and turned it into what it is today. And for years, he was looking for this huge margin of safety. He said kind of his three favorite words is margin of safety. And that's what he was doing for most of his career. I think Charlie Munger in the last decade or so kind of convinced him that quality is actually going to perform better over the long term than deep value. So kind of one of my favorite quotes, that might be kind of what we just do for the rest of this episode, just talk about Buffett quotes. And I think that's totally fine. You guys should take these, tidbits of wisdom and add them to your life. But he said, it's far better to buy a wonderful company for a fair price than a fair company for a wonderful price. And that, that's what I try to tell myself when I'm making my personal investments. You see a huge discount, and every now and then it's just a fat pitch. That's another Buffett quote that you should just, swing, take that home run shot. But oftentimes when companies are really beaten down, there's a reason for that. And I would much rather own the very reliable, very, high quality names with durable income streams, because as Buffett also says, if the business does well, the stock price will follow.
Yeah, yeah, Nick. I think one of the first companies that Berkshire Hathaway acquired back in 1972 was really when this whole quality mantra began, and that was a company that I really love, and I love to eat the candy, and that's See's Candy. And Berkshire Hathaway purchased that company for $25 million. That's six times earnings. And just after they acquired, the company was acquired. He sent a letter out to the newly appointed CEO talking about never sacrifice quality for profit. So See's Candy grew very steadily over the years, really focusing on the quality of the business. And then from that point forward is really when you started to see, the quality starting to rise, and cream rises to the top, so to speak. And then you can just go down the list of a lot of these American well-known brands. You mentioned Coca-Cola. GEICO is another interesting business I want to touch on here, Nick. I'm a customer of GEICO. Again, I've got 5 kids, and they all drive cars, so I've sent a lot of money to GEICO over the years. And Berkshire Hathaway paid about $50 million for half of GEICO in 1976. Of course, now they own 100% of the company. 50% of the $2 billion the company earned in the first quarter. Just amazing amount of cash flow that this company generates. So I know this is a core holding for Berkshire Hathaway. What are your thoughts on GEICO?
Well, the insurance business is kind of how it works for them. They take the kind of the float, all the cash that the insurance has to hold as collateral and whatnot, and then they can invest that. So it's kind of like it's not cheating or it's not illegal or anything, but that's how a lot of these kind of asset managers do. Brookfield's getting into the same business. They get into this insurance and then they're able to invest the float. So that's if you're a conservative investor and if you know how to put that money to work, that's a great business to be in. And especially recently when we saw the S&P sell off kind of due to Trump's trade war, all of these insurance companies, that was where investors were flocking to. No matter how bad things get, you've got to have insurance on your house, your car, life insurance is very important, et cetera. So, that's a very defensive business to be in. And I think it kind of frees them up to be more aggressive with their capital elsewhere, if that's what they choose to do.
Yeah, one of the interesting questions on the call this weekend, Becky Quick asked about disruption risk as it relates to autonomous vehicles in GEICO's business model. This is how the company answered it. This is one of the analysts there said, "See, we at GEICO and elsewhere are certainly trying to get ready for that switch, where we move from providing insurance for operator errors to be more ready to provide protection for product errors and errors and emissions in the construction of these vehicles." And this is what's interesting. Warren Buffett said, "We expect change in all of our businesses. If I'd settle for being in New England textiles, which is where Berkshire Hathaway started, even though it worked well for 70 years or so prior, the world changes. If the game didn't change, it really wouldn't be very interesting. If every time you swung at a baseball and hit a home run, or every time you hit a golf ball, you had a hole in one, it wouldn't be interesting." So he's really talking about the evolution of this business, of this GEICO business model, and really how all of these companies have really adapted to some form of evolution, which, as we know, technology is critical to most all of these business models.
Yeah, no, and that's been the criticism of Buffett throughout his career is he hasn't jumped onto these technology trends. He owns a little bit of Amazon now, I think. He had the huge Apple stake, but that's really it. And a lot of people kind of think it's his lieutenants, Todd and Ted, that are making these tech investments anyway, not Warren Buffett himself. So he's lagging behind, it seems like it, but then when you realize that there's technology in railroads, like you said, the insurance companies are going to be beneficiaries. If driverless car technology is as good and as safe as people expect it to be, or at least as the bulls expect it to be, I know there's probably a lot of people that think it's crazy, but if the rate of accidents drops significantly, like the insurance companies are going to be huge beneficiaries from that trend. So I think it's interesting. People say Berkshire, they're not invested in tech, but they have the same tailwinds behind their holdings that a lot of these other companies do.
Yeah, 100%. Well, I want to touch on a couple other companies. I know I mentioned See's Candies. Another one of my favorites, of course, is Dairy Queen. That's a terrific business model, a very simple business model. But another one of my favorites is in the pizza category. And I'm going to put a chart up here and show you a little bit about Domino's Pizza. The company was founded in 1960. And of course, Warren Buffett bought shares in November of 2024, so fairly recently. When you look at a company like Domino's Pizza, you can see here on this chart a history of earnings growth that goes back all the way about through the Great Recession. So 2009 all the way up to now. This company has been very steadily growing its earnings. And they didn't start paying a dividend until about 2012, which is the light green area you can see here on this chart. But the earnings growth has continued, as well as the dividends. Again, started in roughly in 2012. And the company has continued to grow and grow and grow its business model. And of course, I was a former franchisee of Papa John's many, many years ago.
No rivalry here.
Yeah, no, I was a competitor with Domino's, and I'll tell you, Domino's runs a terrific business, and I think that's going to be a terrific investment for Berkshire Hathaway. Another company that I like a lot, and by the way, pizza is a pretty easy business to operate, but the other business I really like is Kroger. Now, of course, we cover Kroger because we cover a lot of the shopping center REITs and the shopping center sector. And Kroger is definitely a best-in-class grocery landlord with multiple brands they operate across the U.S. I actually went and called on Kroger back when I was a real estate developer and visited Cincinnati several times to take a look at some of the, to meet with the real estate team there. But so as you can see on this chart, Kroger has a long history of earnings and dividend growth going back a long time. And at some point, I believe Kroger could become a dividend king. That is a company that increases its dividend every 50 years or so. But what's really interesting, when you look back at when Berkshire Hathaway purchased shares in Kroger, it happened around February of 2020, just before the pandemic. And since that time, shares have returned approximately 21% annualized, or 172% overall since that period. Now, there was a little M&A chatter going back and forth during this time, Nick, and what are your thoughts on that? I know that was Albertsons.
Yeah, I didn't realize that he bought that stock in February of 2020. I mean, it's almost like he knew something. That's perfect, right? I mean, right before everybody gets locked in their homes and they can only go to one thing, and that's a grocery store. So, good on Berkshire. And that's the types of moves you expect when you own this company. And it's interesting, the Domino's pick. I'll talk about that M&A in a second, but going back to the Domino's pick, Domino's. If you ask somebody what was the best performing stock from 2010 to 2020, you would guess Nvidia maybe, or Apple, or Google, Amazon, etc. The answer, I believe, was Domino's Pizza, which is incredible. They are kind of a tech-enabled pizza company, so that they're getting that fast growth. I think they changed their pizza sauce recipe back in the early part of the decade, which really helped too. But their total returns have been amazing. And it's interesting that, Berkshire is just purchasing them now. So they've missed out on thousands of percents worth of gains. But I think that just goes to show that you don't need to be early. You don't need to time things perfectly. Buffett likes to say, if you're not willing to hold a stock for 10 years, don't buy it at all. Or another quote, he said, if the market was to close down for 10 years and you wouldn't feel comfortable owning your holdings, you probably shouldn't own them. Point is, he's getting into these companies for very long-term investments. I'm sure that's the case with Domino's as well. So that was kind of my biggest takeaway there. It's like, man, he was able to look at all those gains and didn't let that get in the way of buying a great business today. And with the grocery space, I do think that is an interesting spot for consolidation. I expected the Trump kind of administration to be more lenient with M&A. Their kind of DOJ, SEC has been pretty tough still on the big tech. Maybe they'll be lighter on, the likes of Kroger. I don't know if it'll hurt consumers or not. I guess that's what the regulators are for. But I do think a lot of these kind of old real estate-based plays are ripe for consolidation. Kroger is the biggest of the bunch. So if anybody was going to be a buyer, it would be them. And, Berkshire likes to own those kind of big best-in-breed players. So I'm not surprised to see Kroger in that portfolio. And I don't know if they're going to do 20% returns a year from here on out, but I think that's a great long-term holding, like you said.
Yeah, Nick, and I want to touch on one other thing. You mentioned dividends before in Berkshire Hathaway, and one of the ongoing debates. A lot of those companies in the portfolio pay dividends. Companies like Kroger, for example, but Berkshire Hathaway and their dividend policy. What are your thoughts on that? Obviously, we're very pro-dividend. We've had a couple of our episodes already focused just on dividends and growing dividends. What are your thoughts on the Berkshire Hathaway dividend model?
Well, it's interesting. We are happy to call ourselves dividend growth investors. I say it all the time. I'm basing my family's financial future on the dividends that my portfolio provides. I feel it allows me to sleep well at night. That's our kind of motto. Every year I get paid all the time. Every year it grows, etc. We're very upfront about this. I think Warren Buffett is like a closet dividend growth investor because they don't like to talk about dividends at Berkshire. It's kind of like a taboo subject. I think a lot of their big shareholders would rather them not because yes, they are taxed. And that is I think when you're uber wealthy, you want to avoid any taxable event that you can. But if you look at his holdings, they're all dividend companies. They're all dividend growth companies. Even Apple, dividend growth company. Like people think that's a tech company. Well, it's dividend growth. Coca-Cola, all the banks, American Express, Moody's, Kroger, et cetera. You go down the list of his holdings. I should have done this before the video started, but I got to believe it's like 90% plus dividend growth companies. So, he loves dividends. That's for sure. I don't think Berkshire is probably going to pay one anytime soon. That gets asked every single year at the shareholder meetings. Will you do that? I think a lot of kind of smaller shareholders like me might enjoy that dividend, but they don't want to do it. They would rather buy back shares. They are very disciplined. They only buy back shares when the price to book gets below 1.2 times. They're value investors. They buy back their own business and they say, that way it's not taxable. It'll be interesting to me, companies like Berkshire, and I don't know if you have any thoughts on this, like Trump's trying to raise as much money as he can. I've seen there's a lot of people that hate buybacks, especially on Capitol Hill, on both sides of the aisle. So if buybacks ever get taxed, I'll be interested to see if more companies, maybe like a Berkshire, do begin to transition from buybacks to dividends with their excess cash flows. But if I had to place a bet on it, I know I said I would love it if Greg Abel kind of established a dividend at Berkshire, but I don't expect it to happen. I'm certainly not holding my breath.
Well, one of the most interesting comments that Warren Buffett said over the weekend, one of the greatest pleasures, it is the greatest pleasure actually in this business is having people trust you. That's really why I work at 94 when I've got more money than anybody could count. It means nothing in terms of how I'm going to live or how my children are going to live or anything else. But both Charlie, that's Munger, and I just enjoyed the fact that people trusted us. They trusted us 60 or 70 years ago in partnerships we had. We never sought out professional investors to join our partnerships. Among all of our partners, I never had a single institution. I never wanted an institution. I wanted people. Now, when I read that and reread that a couple of times, I think, Nick, that kind of goes back to that dividends topic. I mean, the best way to show the retail investors, and again, he just said it. He's not institutionally focused. But maybe these high net worth, ultra high net worth investors don't care about the dividend, but most people, I would say, would want to have that dividend. And that develops trust between the management team and the shareholder. So, Nick, let's hope maybe there's some dividend policy going forward with Greg Abel. Love to see those dividends. And look, that the whole company, the whole business, what generates the returns, the majority of the returns for the Berkshire Hathaway business are, in fact, dividends from these companies, from these holdings for the company. So it'll be very interesting to see if there's a change in dividend policy, and hopefully there will be.
Yeah, no, and I think I kind of wanted to end this video kind of getting a little bit away from investing and kind of getting more towards life, because I should have said this earlier, but I'll say it now. If you guys want to learn about finance, if you're a young guy, maybe college, I'm not going to tell you to skip college, but I will say the best financial education that you're going to get is reading the annual Berkshire Hathaway shareholder letters. They're completely free. They're on the Berkshire website. Don't be fooled. The website looks like it was built in 1988 and hasn't been updated, and that's probably the case. It's not a fraudulent website. Click on those links, free. Every year he writes these letters to shareholders. Every year they're full of wisdom. They're my favorite. Just if you're ever bored, just go read them. They're great. And so I wanted to say that. I wanted to kind of talk about, it's interesting, you said the trust thing. He says it takes 20 years to build a reputation and 5 minutes to ruin it. And if you think about that, you'll do things differently. So I think he's talking about business deals and making investments, losing investor, shareholder trust, et cetera. But that's the type of statement that can just apply to life totally. So I know at Wide Moat Research, that's something that we talk about, how much we care about our customers. We think so much about capital preservation and really safe SWAN picks. I don't want to write a newsletter that loses anybody a bunch of money, and I'm sure you don't either. So, that's kind of the focus and the trust that we work on. And then the last quote, I was looking for Warren Buffett quotes for this video, and most of them are investment things. But one time he said, "Tell me who your heroes are, and I'll tell you how you're going to turn out to be." And I think that's just a great quote for life. Kind of stand on the shoulders of giants types things. Something kind of just to sit back and think about, who are your heroes? Who do you look up to? And according to Warren Buffett, who's achieved just about everything that anybody could ever want to achieve in their life, kind of, who you admire is probably who you're going to turn out to be like.
Well, Nick, I guess, my hero is Warren Buffett. So
hey, there you go. Hey, that's me too. Maybe in 60 years here, I'll be worth, $100 billion. We'll see.
Great. All right. Well, listen, I want to thank everybody for joining the Wide Moat Show this week. And next week, we're going to have some really great content. We'll probably drop the, what were we going to do this week, Nick? The
value traps. We wanted
value traps.
Yeah, people always ask us, what's the difference between a great value, a wonderful, as Buffett would say, a fat pitch that you want to, swing for the fences on, or a value trap that you're probably going to strike out with and that you don't want to touch. People struggle with that because the line between those two is razor thin, and oftentimes you don't even know the difference without the benefit of hindsight. But Brad and I do have a lot of experience kind of figuring out what's what ahead of time. So that'll be the subject of next week's video, figuring out the difference between a value trap and a great value.
Yeah, I agree, Nick. And listen, I think it's ultra important for us to continue to, we'd rather show you some of these deals to avoid than all of these deals that you're going to make all this money on. I think risk avoidance is really critical for us. And as you pointed out, Nick, principal preservation. So we're going to try to have a fair share of these episodes where we're talking about stocks to avoid. And that's what we'll be talking about next week. So until then, thank you for joining us this week. And Nick, thank you for joining us. And happy swans. Sleep well at night, investing, everyone.
Yeah. Hey, please like and subscribe. And as Warren Buffett said, rule number 1, never lose money. Rule number 2, never forget rule number 1.
Thank you for watching this episode of the Wide Moat Show. Don't forget to subscribe and comment below. And for those of you who comment, I'll be sending out one free book every single week for the person who comments in the stream below. If you enjoy what you see, please sign up for the Wide Moat Daily below. Have a great day. Thanks for watching.